This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and for the next hour here on News Radio 93.1 WFLA, also over on the AM dial at 540 AM, it is the program Dollars and Cents, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. So, I suppose that that's going to mean that we probably want to talk a little politics today. I don't know about you, but I am really looking forward to Wednesday, because that means the midterm elections will be behind us, and I don't have to listen to adults behaving like children anymore. You stop and think about and listen to some of these ads that are running, some of these things that are getting... Have we just lost all civility as a society? Anyway, so we'll talk about that more on the program, and obviously correlate that to markets, economy, stuff that actually matters for your finances. And then we may hit some tax questions as well along the way. And also on tap, we will talk a little bit about fees. Not fleas, but fees. Fees that you pay when it comes to managing your money. So that's a full slate of topics on the program. We always have room for one more, and that one more would be the topic that you give us. And in order to give us a topic, though, or ask us a question, you need to do a couple of different, well, you really just need to do one thing, but you've got a couple of ways in which to do it. You can first call us here at the studio, 407-916-5400. Toll free, 1-866-916-5400. Or you can also send us an email. That email is my first name, Joel, Joel, that's the little A with the circle around it, NelsonFinancialPlanning.com. It's long, but it's the name of the company, so hopefully that sort of spells itself out easily, right? NelsonFinancialPlanning.com. So that's how you can get in touch with us during the course of the next hour. So let's begin. Midterms on Tuesday. I was debating about voting early. My wife voted early, but I think I decided this morning that I am going to be a traditionalist and hold out and vote for Tuesday. Combined with the fact that it seems like the early voting places, because there's not that many of them, are super crowded. But then on voting day, they have a bunch of different places open. So I'm actually thinking that it might be a creative, time-efficient approach. We'll see whether that is the case. If you remember last week on the program, we talked a lot about stay calm, stay cool, and stay invested. And we certainly had a good conversation yesterday at our client event that we had that had almost 200 people at it. And that concept that we were talking an awful lot about last week on the program, and over the decades of this show, we've certainly covered it a lot. The statistics, the numbers really do surprise you when you hear them, just how concentrated the market performance really is. And so if you look at the example that we were giving last week, and I'll repeat it again for this program because we talked a lot about it yesterday at the event. Hard to believe, okay, that we hold a series of events during the course of the year for our clients, about one a quarter. Can't believe that now, I mean, all four of them are in the books for 2018. I just, man, where did that year go? Went by very, very quickly. So we were talking about this notion that the performance of the market, in fact, happens in very, very short periods of time. Most of the time, the market isn't really necessarily doing anything. It does most of what it does in short bursts, both bad and good. I certainly have to acknowledge that. Many of the market's worst days and many of the market's best days are often clustered very close to each other. We always remember Black Monday, October 19th, 1987. The decline in that single day was 22%. What often is forgotten is that during the Tuesday and the Wednesday of that week, it was an increase of 14%. So you see how that clustering certainly does happen. So if you sold on October 19th, right, you would have sold at a 22% loss versus just 48 hours later, you would have made up almost 70% of that loss. And that's sort of how it works. And all it takes is to miss some of those very good days to dramatically undermine your return. So the numbers we gave last week on the program looked at the past 20 years through December 31, 2017. If you had taken 10,000, put it in the S&P 500, so obviously a broad-based, diversified market basket, and at the end of 2017, you would have had a little over $40,000. So 10,000 turns into 40,000 over a 20-year period of time. Average annual return during that period is about 7%, right? Because the money doubled twice. And so if you use the rule of 72 and divide it by the rate of return, 7, you kind of get the rough number as to how the period of time in which the market or the value of the market doubles. So 7% going from $10,000 to $40,000. If you miss just the 10 best days out of that 20-year period of time, which that 20-year period of time each year has about 250 trading days in it. So you do the math, 20 times 250, and that's 5,000. So if you miss just 10 days out of 5,000 days, your return drops in half. Your 10,000 only turns into 20,000. Isn't that just incredible? When you stop and think about it, how concentrated the market's performance really is. And we forget that because we get very fixated on what the market's doing on any given day. We get very fixated on particularly the negative days and sort of ignore the positive days. But you can't ignore that. You got to take it all together. Unless you want to run the risk of cutting your return in half. It gets even worse if you go out to 30 days. Now, remember, 30 days out of 5,000 days. You miss the best 30 days out of 5,000 days, and you know what you have after 20 years in the market? You have a loss. Your 10,000 actually turns into $8,333 if you run the numbers. That's why there's a whole lot of people out there that say, I've never made money in the market. Yep, I believe it. I believe it. For all those investors that say I've never made money in the stock market, I understand why. And it's those statistics that prove that it's very hard to make money. But when you stop and think about it, isn't there a fundamental concept that you could just apply? Staying consistent, staying invested, stay calm, stay cool, stay invested. That would avoid all of that. And in fact, lead you to making money in the market over time. Something to think about. So we talked a lot about that yesterday at our shareholder meeting. Also had some great question and answer period on it. And I may have helped that a little bit. We made a little bit of a to kind of lighten the mood, if you will. That meeting yesterday was a breakfast meeting. So we like to have dinner meetings, and then we always like to have at least one breakfast meeting for our clients that work and just have a hard time getting to an event in the evening. So we do a breakfast meeting, and I thought it only appropriate to kind of lighten the mood a little bit, given the past 30 days in the market, because it has been pretty volatile. So we decided to also provide Bloody Marys and mimosas to kind of lighten the mood a little bit, which actually led to a much more interesting question and answer period. I don't know if those were correlated or not, but had some great questions, particularly about debt and trade, two very important issues, particularly as we're looking ahead to Election Day in a few days. So I wanted to take a little bit of time and address both of those, because I think they are certainly worthy for our radio audience as well. So we're going to do that when we get back from the break, cover those two topics, debt and politics, not debt and trade, and then we will hit politics as well as we continue on the program here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA and 540 AM. One more last comment on that the volatility and how concentrated performance is during short periods of time. Last week, perfect example, right? Tuesday, Wednesday, Thursday, about 1,000-point gain in the Dow. Dare I say, you probably did not hear about that nearly as much as you did when the market was going down. That's, of course, the other reason why it's so hard to stay invested and stay consistent. We talked a lot, as I said, about that at our client meeting yesterday morning. Also, a couple of other great questions that came out, and I thought it worthwhile to share them with you on the radio program. First of all, the debt. Obviously, elections around the corner, and that is perhaps or certainly one of the most significant economic issues that faces our country. I mean, let's face it. Okay, are there fixes that they could do, particularly on programs like Social Security and Medicare? Sure. Okay, Social Security, easy to raise the age. Perhaps not for anybody within 10 or 15 years of it, but certainly to raise the age for folks that are, say, under the age of 50 or under the age of 40. That would certainly go a long ways towards fixing the numbers on it. Medicare, okay, heard this just this past week out of the Trump administration that they're going to reshuffle how the pricing or the reimbursement rates are going to be for Medicare as it relates to prescription drugs. Don't know if you saw that one or not, but basically they're going to take the average price that is paid in other countries and calculate that, and then that's what they're going to reimburse on. It is estimated that alone would save about $100 billion a year. I mean, just these are significant numbers and things that can be done to help at least stem the flow or the increase of the debt. The biggest issue with the debt, of course, is that it can be managed when interest rates are low. Interest rates right now are low, and I think that's one of the central comments or the central ideas that we shared yesterday is that we would expect interest rates to continue to remain very low for very long because the Federal Reserve is well aware of this issue as well. They're the ones that control interest rates. At the end of the day, they're peeling interest rates back up, but I think at some point they're not going to peel them up as much. Here's the biggest distinction. Right now, if you borrow money from the U.S. government, your yield is 3%. Okay? If you borrow money from Germany, your yield is 0.5%. Stop and think about that just for a minute. Your return as a bondholder to borrow money from the U.S. or to loan money from the U.S., to loan money to the U.S., that you're going to make 3%. Do it in Germany, you're going to make 1/6. And if you do it in Japan, it's 1/10 of a percent. So when we talk about interest rates and the fact that they are creeping up a little bit, I think we always have to ask ourselves that relative question. Relative to what? Well, relative to historical interest rates, they're considerably low. Relative to the rest of the world, they're considerably high because the rest of the world is operating at incredibly low interest rates. I think that gives us a flexibility as a country to kind of maintain those lower interest rates, which ultimately makes our debt less of an issue than it might ordinarily be. And stop and think about those yields currently. 3% U.S., 0.5% Germany, 0.1% Japan. If you are an investor, where are you going to put your money? You're going to do business with the U.S. You're going to make that loan to the U.S. government at a much greater rate than you would the German or the Japanese government. All three of which are major economic players in the economy. But it's certainly something to think about when we hear all of these calamity conversations of the U.S., going in decline, the dollar no longer being the world's currency. I mean, you start to hear those types of silly conversations from time to time. And all they are really are conversations because they're clearly not grounded on what actually is happening in the marketplace out there. And the simple fact is that almost 2/3 of all foreign exchange reserves are held in U.S. dollars. The numbers are staggering when if you actually take a moment and research the numbers, what you'll realize is that the vast majority of stuff that's said on the internet is garbage. So that's some perspective on the debt. The other thing too, the other comment that's worth considering is that we talk about our debt. China's debt, twice as big as ours. So just again, perspective. China's government debt is twice as big as ours, double. And they have an economy that's predominantly based on government spending, much more than ours. So before we all start throwing stones, be careful. It may be an ugly-looking block of worldwide economies, but we still have the best house on the block. Another comment, another question on trade, which I thought was kind of an interesting conversation. This conversation on trade is a pretty fascinating one, and one that should have happened at any point in time over the course of the past 20 years. So I'm not going to sit in the studio and throw judgment on the Democrats or the Republicans, but what I am going to do is throw judgment on both of them. Because any president over the course of the past 20 years should have realized this issue and tried to tackle it before it got to the point. And what we're talking about is just the massive theft of technology that China has been doing on a regular basis. This is a conversation that we're just sort of beginning to hear, and we haven't heard that much of it. Microsoft alone estimates that the theft of technology is in excess of $10 billion to that company. That's a lot. That's a lot. And so what's happening, at least what we believe to be happening, is that you're seeing all of these trade renegotiations happen, and China is kind of on the back burner of sorts. I think the reason is you have to understand that that's not something that China has just been doing to our companies. It's pretty much something that they've been doing to every company outside of China. Probably the biggest theft ever in world history has been perpetuated over the course of the past 3 decades. So if you're going to deal with it, and it seems to me that you should want to deal with it, because if you deal with it appropriately, guess what? As an investor, the value of the companies that you own ultimately gets better, right? Because if Microsoft hasn't had $10 billion of technology stolen from it, well, guess what? Well, then they'd be $10 billion more valuable. And their stock price would correspondingly reflect that. So we're going to hear a lot about this trade conversation. We're going to hear a lot about it over the course of the next few weeks and months, and hopefully not years, but it might take that long. There's a real issue here. And as we were talking about yesterday at the meeting, it's an issue that needs to change. It's an issue that's important to you because it affects the value of the companies that you own. If a company that you own has a great idea and then it simply gets stolen, that's not good if you're a shareholder. So stay tuned on that. Certainly a fascinating conversation yesterday at the meetings about trade and debt that we wanted to kind of share some of the concepts and some of the conversation with you about that to give some perspective on it. So we'll slide to that break. When we get back from the break, I do have to tackle the political stuff and talk about that as well on the program. So stay tuned for that right after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. One last thought, which I don't think I completed on that trade stuff. The concept is you get the sort of the deals fixed with everybody else, and you save China for last. Why? Because it's an international problem, this theft of technology that's been going on for decades in China. Not just hitting U.S. companies, but hitting every company that's a technology company, no matter where they are headquartered, unless, of course, they're out of China. So, okay, I think the how that plays out is, and it makes sense to do it this way, is you get deals with everybody, and so you can present a very unified approach with the China situation. Stay tuned on that. We'll see how that plays out. And well, we're not really shifting gears because we're going to talk some politics now. and the implications of that on your money. So, as it stands right now, it appears that the Democrats will regain control of the House. Republicans will keep the Senate, and of course, there'll still be a Republican in the White House. Of course, how long ago was it that all of those surveys were completely wrong? Oh, yeah, the last election. So who knows? Okay, I remember distinctly 2 years ago sitting and looking at these reports and outlooks and what the investment implications were and the economic implications. And that didn't. The unlikely scenario actually turned out to be the actual scenario. So who knows how it will all turn out? But I think there are some things that we can that we believe will be topics of consideration, regardless of who gets elected. The first is I think we're going to continue to have a lot of gridlock in Washington. That goes to the nature of politics in America today, combined with the fact that you will have potentially one power in the House and the other power in the Senate. So that's even more gridlock than what we have seen over the course of the past couple of years. I also believe, and this is just basically looking at the calendar, that we will hear much more over the debt ceiling, the limit, if you will, of how much money we're supposed to be borrowing. It looks like that is headed for a showdown next summer or fall. So that will be a topic. Depending upon how that plays out, that could certainly produce some volatility in the markets. The third comment that we would make on it is that there's no change in the White House. And a lot of the trade and foreign policy and those types of things are directed by the executive branch. So certainly expect trade, as we were just talking about, to continue to be a very central issue. If the Democrats regain control of the House, you would expect to hear much more about a minimum wage hike, Medicare for all, looking to expand antitrust. There's probably going to be a ton of investigations that are going to get launched. And again, all of that is just going to be noise because it's not going to pass through the Senate. And if you remember your little American government course that you took back in high school, bill to become a law has got to pass both the House and the Senate. That probably gives us the best overall perspective. Interesting analysis in Barron's, which confirms sort of many of the things that we've talked about over in the past, and it's titled "Tune Out the Politics, Stick with the Stocks." The reality is that regardless of which party triumphs in Tuesday's midterm elections, history strongly argues, and this is what we were talking about in the beginning of the program, that investors should ignore the results and stay in the market. The reality is if you cut it as to who's in control and which party and how that plays out, and you look back at other periods of time, the historical evidence on this, there's no clear relationship between partisan control of Congress and the performance of the S&P 500, which is basically the broad-based market. So tune it out. You're going to hear a lot about it, but I think at the end of the day, the best advice, as is always the case, be consistent. Don't get too excited one way or the other on it. There is nothing in history to suggest that there is some correlation between which party controls Congress and how the overall markets operate. So don't get too excited on Tuesday, one way or the other. We're going to slide. We'll go to the break. We'll go to a break now, and then when we get back, we'll talk a little bit about taxes. As we get closer to the end of the year, and particularly into 2019, once we start preparing 2018 taxes, that's where a lot of those changes that are kind of lurking in the background will, in fact, actually come all the way to the forefront, because all of those tax changes applied to the 2018 tax year, which nobody's filed a tax return on yet, but they will be shortly. So we'll tackle some of those items when we get back here on Dollars and Cents News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give them a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also simulcasting over there on the AM dial at 540 AM. Never too late for you to join the show personally by calling us and giving us a question or a topic to discuss. 407-916-5400. Toll free 1-866-916-5400, or the email joel@nelsonfinancialplanning.com. Most importantly, make sure that you exercise your civic duty on Tuesday. Get out there and vote. We'll spend this last segment talking a little bit about taxes and what midterms could mean for taxes, because the reality is that there's a lot of changes that are going to come online for 2018. But what might be some of the other conversations that you will hear more about? Perhaps the biggest one that you will hear about is I don't think we've heard the last of the state and local tax deduction. That is the one that is now capped at $10,000 with no index for inflation, and that basically hits folks in high tax states like New York, New Jersey, Massachusetts that ultimately pay a high state income tax and pay high real estate taxes. So those types of taxes all go together and go towards that $10,000 limit. So you're going to certainly hear a lot of conversation about that. Might also hear some conversations about tax rates. The current top individual tax rate is at 37%. Some folks in the Senate, particularly on the Democratic side, have already floated the idea of bringing it back to 39.6. Unlikely that you will see much movement on that, particularly assuming the Republicans control the Senate, and of course, still a Republican in the White House. May also hear some conversation about the corporate tax rate as well. Some of the proposals out there trying to get that rate back up to, say, 25%. I doubt that one really is going to have much of a change or a chance of that happening. The estate tax exemption, how much, what's the value of your assets that would pass without having to pay any form of estate? And this one didn't get talked about a whole lot because the estate tax exemption had already sort of been getting shifted up to be a pretty high number, north of $5 million last year. Well, these tax changes that went through effectively doubled that, so that the estate tax exemption today is north of $11 million per person. So that estate tax exemption has been steadily creeping up over the course of the past 20 years. I remember about that time ago, it was down around 600,000, which is a very low threshold. Obviously, over the years, it's really accelerated and increased. And then these tax changes that happened about a year ago, a little bit over a year ago, wound up doubling the estate tax exemption, so all the way up to $11 million per person in terms of that estate tax exemption. Certainly, you'll hear out of Washington conversation about bringing that back down to that $5 million level. Again, not sure that one's really going to have much of a chance. Also, tax credits and deductions for medical expenses and things like that. A lot of some of those credits are set to end at the end of 2019, and so you may see that, or you may actually see that getting resolved in towards the end of 2019, where some of those credits that were getting phased out. The biggest one of which was the expanded deduction for medical expenses, where you can deduct, assuming it's over 7.5% of AGI rather than the old 10%. You may see that come back into conversation. And then, of course, with all of these tax changes that were done last year, all of them or many of them are set to sunset or basically expire in the year 2025. They were not permanent changes. So certainly there'll be conversation about trying to get those extended. But again, that one also, unlikely to be something that you'll see much movement on in Washington. But certainly, 2018 taxes will show an awful lot of change, if you will, over prior year. One of the biggest ones, of course, is the personal exemption. You used to be able to get a deduction for each person in the family. That was $4,000. That personal exemption deduction is gone away. That was the give and take, if you will, to get to that higher standard deduction. So that standard deduction may have gone from $12,000 up to $24,000, but if you're a family of three and each of you was getting a personal exemption of $4,000, so that's $12,000. Well, then guess what? You're nowhere different than where you were under the old tax rules. So one of the things that they did was to sort of get the math or the numbers to work on the standard deduction. They eliminated the personal exemptions. If you do the math on it, you can see where, well, wait a minute, that's not as dramatic of a change. But you do not have the personal exemptions on the on your tax return like you did before. In terms of finances and financial implications, in the past you had the ability to write off your investment advisory fees. The answer is that is gone for this year. That used to be a miscellaneous expense deduction, but that all of those were eliminated. That really affects people that are working on a fee only type of basis. So if you're on a fee only type of basis, and we're using this exemption to be able to write expenses off, the reality is that that's not going to be an option anymore. So be careful of kind of how you're paying, and most importantly, what you're paying, because your ability to write that off and get some tax savings on it goes away for 2018. So that's significant. The other item with this higher standard deduction is that this notion of charitable giving, you may not get as direct a benefit for charitable giving as you used to, because those with the higher standard deduction may find that, well, my charitable contributions aren't going to add up to enough to make a difference for me to now itemize going forward. So what that means is that you may really want to look at the notion of kind of doubling things up, if you will. And the same analysis would also apply on real estate taxes too, although on that you'd have to watch that $10,000 limit. But by doubling things up, you may wind up kind of getting into a pattern where, okay, this year, which is the year that I doubled things up, I'm able to itemize. Next year, well, I'll just take the standard deduction. The year after that, doubling up again, I'll just do the itemized deductions. And what I mean by doubling up is you pay it in the same calendar year. So if we look here in Florida at the real estate taxes, you get your bill usually in November. But you can pay that all the way up until April. So then this year, if you wanted to say double up next year, what you would do is you would pay your real estate taxes in January of next year. And then next year, when you got the next real estate property tax bill, you would pay that in November or December of that year. And because both of those payments happen in that same calendar year, you could use them as deductions in that same calendar year. Same thing would work for charity as well. You may want to make a charitable contribution. You make a charitable contribution here at the end of every year, make it in January, and then also make it again in December. So those would be the way in which you could certainly double things up to help take advantage of the new rules and the significant change in the standard deduction. But a lot of those types of deductions have gone away, particularly, as we were talking about a little bit earlier, that unreimbursed expense category, or the miscellaneous expense category, which picks up the unreimbursed employee expenses. It picks up tax preparation costs. It picks up investment advisory fees. Those types of things, and your ability to deduct those has simply gone away altogether. So be aware that the doubling up strategy really only sort of works for the things that you can still deduct. And for the most part, that falls in the category of charity and your real estate taxes. Hard to double up the other stuff. Hard to double up medical expenses, because if you need to spend some money for your health, chances are you probably can't put it off till January. So just certainly some things to think about on taxes as we get into that tax season, which will be 2 or 3 months down the road. You'll certainly hear many more items and discussions on these taxes, because the taxes you're about ready to prepare are going to be the ones that will have probably the biggest change in the past 30 years will be playing out on that new tax return. So we'll stay tuned on that one. Most importantly, get out and vote on Tuesday. That is Election Day. Make sure you exercise your civic duty. We will be back next week on the program to break all of those election results down and talk maybe a little bit more about kind of where we see things going depending upon how the election turns out. But remember, bottom line, doesn't really matter. There's no historical kind of correlation. So, but thank you for listening to the show. This has been Dollars and Cents with your host, Joel Garris, here on News Radio 93.1 WFLA. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.